to the firm. On the show this week, a tax circular forces alternate investment funds, or AIFs, into an existential crisis. And yet another insider trading case tests the definition of connected person. Our top story: on Monday evening this week, a circular from the tax department took the private equity industry by surprise. The CBDT clarified the taxation of alternate investment funds, or AIFs, in a way that threatens the very basis of how the private equity industry structures its funds and raises capital. Pariswini Upadhyay reports on the CBDT surprise and its implications.
SEBI's 2012 Alternate Investment Funds, or AIF regime, categorized funds based on their objective, investment restrictions and benefits that they'd like to avail. Category 1 includes venture capital funds, SME funds, infrastructure and social venture funds. Category 2 includes private equity and debt funds, and domestic hedge funds fall under Category 3. The budget next year brought taxation relief for AIFs, but only for Category 1. They were given a tax pass-through status, meaning the income is tax-exempt at the fund level and is taxed in the hands of the investors. Category 2, or private equity funds, are taxed based on how they structure the fund, that is, a company, a limited liability partnership or a trust. So far, the industry has followed a trust structure.
Private equity funds in India usually have been structured as trusts. As per the alternative investment funds regulations, you can structure them either as companies or as limited liability partnerships or as trusts. Now, companies have a issue in terms of dividends being distributed, taxed once again. Limited liability partnerships are regulated entities, and therefore you'll need regulations, or certain compliances to be done with the private, with the private equity funds. And therefore trusts were the most popular route in terms of how they were structured, because it's relatively easy to manage and you have to have only a trustee and an asset manager and not too much of regulations around it.
While there are a couple of other options available, but I would say almost everybody is structured as a trust. So what you have is you have a contribution. First you make a trust, register a trust with the registrar of assurance, then go ahead and prepare a contribution agreement and ask investors to invest through that contribution agreement, and that is how all the private equity funds are structured.
The trust structure came handy for tax benefits. Under the Income Tax Act, determinate trusts get a pass-through status. For a trust to qualify as a determinate trust, the names of the beneficiaries should be specified in the trust deed, and on the date the trust deed is signed, the individual share of the beneficiaries should be ascertainable. If a trust doesn't pass these two tests, it is taxed at the maximum marginal rate of 30%.
As far as the fund 2 is concerned, which is what the structure most of the private equity funds are entitled to use, there is no pass-through structure there. And so everybody hoped that while there is no specific pass-through structure or tax benefits provided under that act, you have what is called Indian Trust Act 1882, which provided that there are, under certain sections of that act, you could still claim benefits on like manner to the investors. And everybody assumed that we will continue to have some kind of a status whereunder the trust itself is not taxed. If at all it is taxed in the same manner as the ultimate investors would have been taxed. So that is how was the assumption in most of the funds case.
This assumption has its roots in the 1996 AIG order by the Authority for Advanced Rulings. The AAR had ruled that for a trust to be a determinate trust, it is not required that the exact share of the beneficiaries be specified, and that if there is a predetermined formula by which distributions are made, the trust would still qualify as a determinate trust.
If I look at it very, very legally, an AAR ruling applies only to the taxpayer who sought it, which is AIG in this case. The ratio of that ruling, the principle of law that was laid down in the ruling to say that, when you have a formula determined for the allocation of the beneficiaries' shares in the total value of the fund, that should be sufficient to regard the fund as a determinate trust rather than a discretionary trust. I think that was something that the industry was relying upon based on past experience, to say that the courts would take a view which would be consistent with that principle.
This week, the CBDT burst this bubble via a clarificatory circular. It said that where the trust deed does not name the investors or specifies their beneficial interest, the entire income of the fund will be taxed at the maximum marginal rate of 30% plus surcharge.
The whole trust concept and the way the Indian structures have been formed in the past will no more remain valid, because nobody would like to pay 33% capital gain tax on as against normal 10% or 20% or 0%. So this is a completely different regime. I mean, everybody is back to the drawing board to see what exactly to now handle the situation.
The challenge could be that in couple of situations, like for example, in case of a defaulting investor, there is a provision in the fund documents that the fund can forfeit the units of the investor, in which case the beneficial interest percentage of all the contributors change. Similarly, under the new amendment of SEBI, which was introduced few months back, SEBI has mentioned that in case there is a material change in the private placement memorandum, then the fund needs to give exit option to the investors. Now, if some of the investors exercise the exit option and the other investors do not exercise the option, then again there will be change in the beneficial interest percentage, in which case there could be a risk of the pass-through benefits of the trust going away.
Add to that the problem of tax credit. So far, it was possible for individual investors to offset capital gains from the fund against capital gains losses in their other investments. Now, if the tax is to be paid at the fund level, investors would not be able to get any tax credit by offsetting. So, what next? Experts told me that PE funds could consider the LLP structure, but the tax department may tomorrow argue that since the LLP is formed for the purpose of business and not investment, the income should be taxed as business income. Seems like private equity is caught between a rock and a hard place. In Mumbai, by Aswini Upadhyay.
Like I said, AIF's in an existential crisis. We're going to head into a quick break on the firm. When we come back, yet another insider trading case tests the definition of connected person.